Okay, great. So let me get started here. So welcome to the Capital Discussions Market Analysis. I'm Tom Nunemaker with Jim Riggio. And this is our disclaimer that'll be in the bottom of all of our web pages, but just real quickly, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So now that we've got that out of the way, so tell me what's going on with Bill.
What we were talking about is just what's been going on in terms of, and this was the longer term trend, right? It wasn't specific for today. But what we were talking about is that when we've had during more calm periods of time, okay, implied volatility has been extremely low the last couple of years. And when implied volatility is this low, it's difficult to sell volatility to make a living, right? Because that's when you're selling an iron condor or putting on a butterfly. You're short volatility, you're short Vega.
Sure.
Don't want to talk about calendars right now because that's not being purely long, right? That's much more of a difference of 1 month versus another. But just in general, iron condor sellers, butterfly, if anybody who trades a butterfly, or you're selling strangles or straddles, you're going to be short volatility. The problem that has come up is twofold. Number one, the at-the-money volatility. The at-the-money implied volatility of different options has been much lower. However, the deep, or the far below the money, those volatilities are a lot higher. So the difference between the two, is as you go further down, the implied volatilities have gotten higher. That's what we call, put skew. So in a low volatility environment with steeper put skew, it's more difficult to end up making money. The other thing that has happened is that anybody who's read, investment options as a strategic investment, from Larry McMillan, you'll know that if you've taken a look at some of it, he's talked a lot about how implied volatility is usually had been higher than what the actual volatility has been. That's changed a lot over the last few years because we have actually had, spurts of movement, either up or down. And so what's happened is that back selling iron condors, we were always able to, in terms of the higher condors, we were able to make a little bit of money every month, right? Make a little bit of money, make a little bit of money, make a little bit of money. And then when we would end up losing, usually it wasn't because volatility would go from, 12 to 31 back to 12. It was, all in 4 weeks. It built up over a couple of months. You lose on one volatility, on one butterfly, but you were selling the next one at a higher implied volatility, and then you'd end up being wider and wider. So where it used to be the iron condors were make a little bit of money, make a little bit of money, make a little bit of money, lose maybe the same amount or a little bit more. Now it's kind of make a little bit less money, make a little bit of less money, make a little bit of less money. Then when you end up losing, you're losing a lot more. So the whole thesis of what the trading strategy was on in terms of the underlying capability of it has changed somewhat. I was telling Bill that I thought that they were the greatest lemonade makers in the world that I had ever met because, we were all given the same batch of lemons, right? Our business is done. Now, remember, for us, we're traders. These guys were our guys. This was their living. This was their job. They didn't have anything else in life except for trading volatility. So what did they end up doing? They saying, well, nobody wants to end up, every month making a little bit less, making a little bit less, making a little bit less, And then when you lose a lot of money. So basically they said, well, can we end up taking the other side of the trade? Well, the problem with actually going out and selling the other side of the trade is that nobody wants to lose a little bit of money every month and then hopefully, okay, the volatility picks up and you make money then. Except for maybe if, you're a doom, gloom, and boom guy, okay, or a Nouriel Roubini fan. But I think that in general, that's not an attractive way to end up making money for people, in the hopes that the black swan does, come flying in your door someday. So what they've ended up doing is that they actually build hedges doing that. So think about this. So now every single month when and I'm not saying that they buy the iron condors, but I am saying that they're putting on hedges. Are they ever using buying put verticals to put them on? Sometimes. They have, maybe half a dozen different hedges, and the hedges are going to end up being specific to the underlying. But when you think about buying a put spread below the money, okay, and Tom, since you have the ball, I don't know if you want to end up, did you already hand it to me?
Yeah, I gave it back to you.
Oh, you did? Okay. So what I'm going to end up doing is I'm going to end up just showing you real quick. I'm going to share my desktop, and let me show you this monitor. Let me come over to here. Let's take a look at SPX. Should I look at SPX, or you guys want me to look at RUT? Tom, what do you think? I don't know if you have a question. SPX is good enough for now, right?
Yeah.
Okay. Do you see my Thinkorswim screen?
Looks like live vol.
Okay, we want to share a different screen then. How do I? I don't want you to end up going through this one. Tom, I'm not sure where to
Maybe
go.
sharing and then reshare and pick a different screen?
Yes, except for I can't end up. Oh, here, it's up here. There we go. Let's go share. I think I got it.
Okay.
Okay, so we want to, which one is it? Share. There we go. Okay.
Now I think for some screen.
Yeah, I just figured that, I could have done it on the other one, but I just figured Thinkorswim, most people would prefer the Thinkorswim ones, but I can end up showing you on LiveVol if anybody prefers. If I just go out to, say, January, and I just have 25 strikes going down to, let's go maybe down to closer to 1900, because I think that's where a lot more people would be selling. So what would end up happening is that when you take a look at the difference between the at-the-money implied volatility and the, let's say, the 1900, there's a significant difference. And people say, well, I don't end up doing butterflies that wide. Okay, that's fine. So then now let's take a look at maybe the 1900 versus the 1875. Take a look at the difference between those two, right? It's 21.64 versus 22.62. It's almost a full volatility point difference that you're giving up. So and this is relatively flat right now compared to the way other things had been. One of the things that I do like and I will end up bringing this screen over from LiveVol, is being able to end up seeing what the skews look like. Those different skews. And let me just go here for 6 months. So, and here is the picture of the skews, where if you guys remember, right, this implied volatility on the left, the price of the underlying, which is SPX, down on the bottom, and then you have your different expirations here in different colors, and every color is up here. So what ends up happening is that if you go back, say, 3 months, those lines were a bit steeper going to the left. So what ends up happening, you can see if I go out to, what we were looking at was just January. Right, so let's get rid of a lot of the extra crap on here and just to kind of focus on the one that we were looking at. which would be this one. Okay. If we end up going back and taking a look, because volatility has gotten a lot steeper here, the center of the curve, or the right of the curve, has moved up a little bit compared to as a percentage where this was. Before, it used to be steeper. So what they're looking at, and what we talked a little bit about, why their hedges, when you're trying to hedge a portfolio, why their hedges work so well. And if you take the simplest of all ways that I'd like to, I know our audience, who are options traders, would end up hedging, right? They would never go out and buy just a plain long put. They would end up doing, at the very least, I would think, something like buying a put spread, where they would end up buying something here and then selling something out here. Now, that's exactly what EAB does when volatilities are low. What do you do when they're higher and the second month maybe has risen more or less than the front month? Well, then you need to end up looking at different. That's how come one of their half dozen or so proprietary screens and hedges is just using wider put spreads, right? When vols are steep, the key is to know when to end up using it. And the problem I think that a lot of our audience has faced is that if you're just trying to do the same trade all the time, you have to know when they're expensive or when they're cheap relative to the overall market, and that's what Bill and I were talking about today.
Yeah, it should be interesting to go in depth on that on Thursday.
Yeah, I definitely think so. It's because Bill is like, I can tell people that, but it's going to take me, 10 minutes to tell them. I'm like, yeah, but I think you're going to have like, more than an hour's worth of questions.
Right. So interesting market action the last few days.
Yes, it has been. I was just looking at some of the questions. Some people love to leave, right? I mean, you gotta love a black swan. Okay. Other things that I ended up seeing in here were that the skews, came down a bit today. Yeah, they did. They got a little bit fair. One of the things that Bill will, I'll have him show everybody, is that they use, and I don't know where they know the guys from. Some of the guys that they had known at some point in their career had left, and they built an institutional skew tool. So what they end up doing is that, how Thinkorswim ends up taking a look and tells you what percentile, the vol is in, as a whole. They have an institutional tool where they can basically pick anything and they can find it. So for example, they'll look at the money versus the, say, the 25 deltas and seeing what does that skew look like, right? The at the money put and call versus the 25 delta call and 25 delta put. What percentage or where are they? They also have a modeling tool to be able to end up doing event-based risk analysis, like, say a Fed meeting. And he'll end up showing you how they end up doing some of their skew modeling and what it can end up actually showing. So yeah, it is a little bit interesting that it is flatter, and we talk about that every day. Has the VIX spike single a la Uncle Larry, the FWIW? David, I don't know what that is. I'm assuming that Uncle Larry is Larry McMillan, but I don't know the FWIW.
That's for what it's worth.
Ah, okay. I did not know that.
Speaking of the Fed, don't we have the FOMC is releasing something on Wednesday, meeting announcement?
Yep, we do. We do. And, that's one of the things that, and the problem is, we were worried what's actually causing all of this issue. When we take a look at the market, because this has been just a horrendous December compared to a lot of other Decembers. If I take a look at here, I'll just bring over the calendar. Okay. The biggest thing, the FOMC stuff that comes out on Wednesday. You know, the other issue, okay, that I ended up seeing was, oil. Oil just continues to end up having a lot of, we've never had this much commodity volatility in the markets compared to the overall market. So when I take a look at, let me take a look at oil here, and perhaps instead of looking at an hourly chart, you know, well, it's you can end up seeing what's happened. An hourly chart going back to early September. Okay, we've just continued this precipitous fall. Um, we were also discussing today, um, since oil has driven a lot of this volatility, um, when does it stop? When does it stop? I read a bunch of different things on it. We've discussed a bunch of different things. I read a paper from Jeremy Siegel over the weekend who thought that it was going to stop somewhere between 50 and 55. And he made the cases. What's going to be the real question is that once it ends up reaching a bottom, it's going to end up snapping back up. Where does it come back up to? Siegel's analysis told um, 60, 65 would be the first area, that it should end up bouncing at least $10 once it ends up finding any type of footing. The other thing was that um, the UAE came out and said that they weren't going to change, nor was OPEC going to change their current quotas, but they had left it open, and so we got that was just more of a sell-off. Japan continues to end up buying their bonds. Things had gotten a little bit worse in China in terms of the banks. So I don't want to make this a macro thing, but when you have this level of a precipitous drop in oil, it's hard not to end up saying, well, how does that end up affecting? One of the biggest things that I also had seen was that a lot of strategies that had made money in volatile markets, and here's just a daily chart of oil, had made money in volatile markets are not making money here. Some of the arbitrage stuff that I had been involved with helping a couple of groups work with, um, their Decembers are usually very, very quiet, and this December has been very, very quiet. Um, so, I mean, it's just ugly. I mean, I don't know how do you protect yourself. Okay, companies that end up having this level of exposure to commodity and energy pricing is just it's just terrible. When you take a look at a lot of energy trusts, think about what an energy trust is. You own the oil in the ground, and what you're doing is that you're buying your future payments from them pumping the oil out or pumping the gas out or the fracking or whatever it is, um, and you're buying that future stream of payments. And how much do you get for it? Well, the answer is you don't know, because oil goes up and down. Right? Natural gas prices go up and down. Energy prices go up and down. So they usually sell it at a discount, but they don't sell it at this level of a discount. So at what point does any of the collateral that those energy trusts held will end up causing issues and margin calls for other things? And is it just a domino to fall, and then having to sell other assets to end up paying for margin calls, or having, if you're too leveraged in areas, the selling in other areas happen? And the answer is, yeah, we've seen that. We're seeing that, right? Don't forget, the energy stocks are also dragging down the market. When you take a look, I forgot what it was. I had looked it up the other day. But, let me use 10%. I know that's not the right number. But if 10% of the market's getting absolutely annihilated because of this is going on with, energy prices, it's going to bring down the whole market. And at that point, all of the technicals, all of, the investing, all of the volatility that we would end up expecting is kind of now it's misplaced, right? Or I don't want to say it's skewed, but it's concentrated, but is it causing other problems? I had mentioned, I think it was in the trading group last week, a lot of times when we look at this, very, very low oil prices like this, it's a good thing for Main Street. It's a terrible thing for Wall Street. Unfortunately, a lot of people's, pensions and IRAs and other things are, in Wall Street. So it seems like we're getting steeper at this point, okay, in oil. It's an amazing thing to me, Tom, because when you take a look at it, it's not like the demand for oil is going to go away.
Right.
I mean, we're going to end up looking back at some point. Now, I don't know if that's, in January of 2015 or January of 2020, but at some point we're going to look back and say, can you believe, okay, that oil got down to 50, in the 50s, it was $55, okay, a barrel?
Right.
And you'll say, I can't believe it was that low. And how many people are saying, again, 2015, 2020, they're going to say, oh, my God, if I could have bought it down there. Well, guess what? It's here. Does that cause more problems?
Yeah, I saw there was a number in Moscow floating around, number 63. It's Putin turns 63 soon, and the ruble was headed towards 63. It's now at 65. And oil was headed towards 63. It's now below 63. So 63 is a big problem for Putin.
But if you remember, okay, it's whenever people come up with numbers like that. Do you remember it was 10,000? I think it was 10,000. There was during the dot-com boom. Okay, when the Nasdaq was racing up above 2,000. Okay, and the Dow was at whatever it was, 8,500, not 9,000 or something like that. It was there were some people writing articles. Who will make it to 10,000 first? Okay,
Right.
The 63 number. Okay, with Putin's age and stuff. Those are the. By the way, take a look at the consumer confidence number that came out on Friday. Right? I don't know if you saw it, but it was I think a 7-month high. You take a look at I thought that, oh, well, maybe it was maybe it was the whole budget issue, okay, with Congress. Would the Republicans try to hold up things? Okay, I guess they learned their lessons from last time, and they didn't, and they got it through. And there's a whole bunch of political wrangling, but we got it through, right? So that was okay here in the U.S. I look at this thing and I can't believe it either. I know, I think, who was it, Dave had said you can't believe it, and neither can I. I just don't understand this market. I mean, when you take a look at what, right, did everybody see what happened to the S&P today? If I come over here, I mean, it seems like it's been like this now for, it's just been incredibly ugly for long periods of time. We open up, we end up running up higher. Everything looks like, we're okay. We've reached a bottom, that hard sell-off at the end of the day on Friday. Okay, we make everything back. Everything looks great, okay, after the first half hour. Then the bottom falls out again. I don't, you take a look at what's happened over these days. Oh, by the way, if you guys don't do this is an important one, okay? So let's get to the market analysis piece that you can actually trade off of. Take a look at what's happened in the last hour. Selling, 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 selling. Oh, we had one good day. Selling. And then before that, so in this whole week and a half where we have lost basically 100 SPU points in a week and a half. We've sold off in the last half hour of every day, or the last hour of every day, except for one. And I don't even know if I would end up considering this part of the drop, because if you take a look at it, by the end of the day, it's kind of like, oh, well, maybe we could have just ignored it, right? Because it was almost an unchanged day. So it's been really, really ugly. Now, here's the next thing I want to end up showing you guys. If I end up doing this and I forget, Tom, what I have to do is I have to take the non-market hours out. Settings, show studies, highlights, is it pricing, time, equities, futures, show extended hours, highlight them, and I want to take them out. Okay, right? So now you're just looking at just the trading hours,
Right.
okay, of this. And if you take a look at, well, what's happened, okay, when we've had any buying, take a look at this little tiny upswing from 550. It doesn't even count. You take a look at how big the selling bars are. Right? Don't forget the futures close at 415, so I have one extra bar at the end. So the bar you always want to look at on this graph is really this one. You take a look at the hard selling, okay, that's happened, versus when we ran up at the end of the day. Look at how puny that bar is compared to the selling bars. Okay,
I like your analogy, the taking the foot off the accelerator.
There's not enough commitment from the buyers. Now, a lot of times what ends up happening in December is people think, but there's no volume, I don't care, it's not that big of a deal. Now, one of the things that's also happening here is that the selling it could be accelerated because, volume is lower in December. Right? But it's been an ugly market. Well, when I took a look at today, Bill Visconto and his partners and I were on the phone for a while, and if I just show you a 5-minute bar, I want to show you just today. We're watching this thing go down in the morning, and we're like, oh my God, this thing is just so unbelievably ugly. And when you have failed attempt of a rally after failed attempt after failed attempt, it's not very, very good. Now, you take a look at the average volume of, like, this whole period in here where we were buying, right in here, where my cursor is, then look where the selling is to the left. Look at where it is over here.
Yeah, right? A lot higher.
A lot more sellers than buyers. You can end up going and taking a look at it. I like to break it down to, when I'm looking at volume, I like to break it down to 5-minute bars. You can even break them down to 1-minute bars when you're looking at it to see what that volume looks like. Here's one of the things that I'll look at again while we're doing technical analysis. Let me bring things over to here. It's the only place I ever look at a 1-minute bar. I'll look at 1-minute bar, like here's a great example. Okay, here is a great example of how to look at volume. Look at the selling here at 1040. By the way, I think I'm off. I think I'm on Chicago time on this graph. The volume is very, very high. What happened to the next bar? It's kind of like the sellers let up. Look at the big bounce we had. Look what happened to the volume. The volume diminished. It got lower. It got lower. Okay, this was not buyers stepping in. This was their sellers taking their foot off the accelerator. Okay, because if they kept selling, okay, there wouldn't be any more. There wouldn't be any more buyers to come into the market. You could end up seeing that, okay, time and time again today. It just how ugly the market moves. You can look at it in two ways. One, you always look at volume, okay, on your bars, and two, you take a look at how quickly things can accelerate. the old expression of taking, the stairs up and the elevator down, and I know some of you guys have heard me joke that the markets moves a lot quicker now. It's more like taking, the escalator up and the window down. It does move rather quickly. It does move rather quickly. But if you keep a look on your volume, you'll end up getting, that's the first place you'll always see signs that the market's starting to turn around. Doesn't mean that when the volume comes in, okay, you can end up shouting, all clear, we're going up, every day for the rest of our lives the way the beginning part of the year seemed. But you won't see a turnaround happen on lower volume. You just won't. And that's true of almost any time frame. You can take a look at it on a daily chart. If I go and I take a look at this on a daily chart, look at the volume on the way down versus as we're creeping up. Okay. Same thing, when we finish this, there's always going to be a lot of selling, okay? When you have right? You love to see low bars like this, absolutely huge volume. Because at some point you're saying, okay, it's capitulation. It's capitulation, the selling is done. And then you can see they're still buying in, we're going to come up, okay, and we've seen to flatten out. Take a look at how high our volume is here versus how high our volume got on previous ones when we ended up having even the harder sell-off. Anyway,
there's a good comment or question. Why do you think VIX fell today, although the SPX also fell?
The VIX has been acting extremely strange. Like, for example, if I show you down here, let's do the same thing for VXX. Let me come over here and show you maybe just a... This was Friday. Okay. Here, I'll put up VIX. The only problem is with VIX, and I could put up VIX futures also. Does that...
Yeah, look at the size of the
normal to you today?
Pardon me?
I said, look at the range of these bars.
That's crazy.
So you mean, you asked me, why did we have a slightly lower finish than where we started? I mean, it's crazy right now. And this was after we finished, right? After we finished our, budget issues. Now, did any of this have to do, let's bring up oil over here. And let's come to the same thing. We're going to end up doing 30-minute bars. And let's do style. Let's just look at the trading day stuff. Show extended hours. Let me get rid of that. Did I put that? No, I didn't put that in here. So let me get settings over here. Equities. Options. And futures. Okay. What is the VIX? It didn't move on any of them. Futures. If I take that off and hit apply, nope, that didn't do it. Options. If I take extended hours off, nope, that didn't do it. It's not an equity. I guess it is an equity. Who knew? Right? Right? Think about that. What is a calculated index? Okay. But if I come over here and I take a look at this 30-minute chart, and let me make this one a little bit bigger here. I just want to try to line them up a little bit. Okay, we're lined up relatively close. you can see what ended up happening, right, to oil, right? We're getting pushes down, and look at the green bar, right? There was a lot of heavy selling. One green bar, one green hour the entire trading day, and then a push down afterwards. Remember, oil closes at what, 1 o'clock in Chicago, 2 o'clock Eastern. Um, I don't know. I do know that it is oil that is just as scary as anything. Um, and to me, I can understand the panic in buying oil, okay, through conflict in the Middle East, or through, um, things that can end up disrupt supply. But right now, the demand isn't increasing, but, this is a self-inflicted, and quite frankly, it's a U.S. inflicted, okay, issue. Why is it a U.S. inflicted issue? Because the U.S. has been, okay, developing more and more oil fields that were dead for, decades through fracking. And as those capital investments have started to produce more and more oil, we've increased, okay, our production. And don't forget, we're the biggest users in the world. I don't know. I got to tell you, I just don't know where we go from here. But I do know it's every time I think it's the budget, it's interest rates in Japan and quantitative easing. In the end, it seems that it really is the price of oil that's driving things.
Okay, I notice we're in backwardation. If you look at VIX Central real quick.
Yeah, and I have that up over here. So we got into pretty heavy backwardation today. There's only about, I think, probably about 15% or so of the, I'm sorry, there's almost the entire trade is in the second month at this point. So this is a really good point. Tom, thank you so much for bringing it up. You can look on VIX Central, or you can look on any of your sheets. Like, for example, if I come over to here and I take a look at the VX futures, I want to look, I want to trade. Let me come over to here, analyze, and I want to look at, will they give me the whole thing here? Oh, I don't know if they tell. Here they go. Tom, look at the front month.
Yeah, expires tomorrow.
All right, so there's no money in it. So quite frankly, when I look at this backwardation, this almost doesn't count, because really we're going to be right now we're all in the January contract. All in the January contract. And we'll be there for a little while before we start to roll into February. Now, from January to February, we're in 1.3% contango, which, you always have this messed up version between December and January because of the holidays. It's kind of like volatility comes out, but in this case, it really isn't. I think that's. I got to tell you, this markets have done nothing but confuse me over the last, week. I thought that everything looked like it was moving just perfectly the way it normally would in December, and then we ended up having, this happen to oil. And in the beginning, I don't think it was that big of a deal for oil at the very beginning. If I go back and I take a look at, the one that we were looking at before from an hourly perspective. Oh, sorry, let me do that on a daily perspective. I think you end up going back. I think that, when we were holding above $70, okay, it was reasonable. Nobody thought that, anything was, getting to be absolutely, dire in terms of what was going on. Right. And if I take a look at that $70 mark, look at where I am. I'm back in 2010. If I take a look at the $70 mark, we had touched it a couple of times since 2010. Don't forget where we were in 2010. We were just saying, are we really out of, the Great Recession? We're trying to claw our way back. If I go back even further, I don't know how far they'll take me back in oil. Let me come over to here and do. They won't get me any further back than here. Right? It's probably a little bit easy to see on a monthly basis. Oil traders are used to seeing things like this, and then they come back up. They're used to seeing, big drops, and then, but this one is just like, I don't know, Tom, this one reminds me of the final scene in the movie Thelma and Louise.
Yeah.
You remember that one? When the car went off the cliff?
Actually, I didn't see that movie.
Okay.
I can imagine, though. It does look like a pretty steep drop.
Now, the thing is that, and here's the thing that's kind of weird, right? The thing is that this does not tell me that there's panic. Yes, right now there's short-term stuff. But think about this for a second. This future, that goes out, tomorrow, versus this that ends up being after the Fed meeting, wouldn't you think that they'd want to hold some volatility for the Fed meeting? Right? This one's already done by the Fed meeting. This one is not. Now, granted, It has to go through Christmas. So, every time I keep thinking, well, the fear just appears to be short-term. But it's getting worse and worse and worse.
Yeah, it's hard to read the market, like you said.
So anyway, thoughts, questions?
Well, the chat's been pretty busy.
It is then. Okay. I have not been reading. So I don't know, Tom. If you've been keeping track here, anything? Would you mind reading some of them?
Paul says, watch JNK and HYG for defaults of the energy bonds and leveraged loans.
I will tell you, and by the way, Paul, save the question for Bill when he speaks on Thursday, because while he can't tell you who it is or anything about it, they do have one very good junk bond, leveraged junk bond client that they build hedges for. So he's very, very familiar with HYG, and how to end up hedging in what's been going on in the options. And I don't. You can end up seeing here, right? This is the monthly. It's only been the last month that we're starting, right? The first couple of months of oil dropping, they didn't care. Right now, ooh. By the way, don't forget, this was 2008. So look at what I'm saying. This right here was the U.S. Budget deficit. So this is, this is like the biggest drop since either one of those two things. Right? And we don't have a news event that is this relevant, other than really, every time we keep trying to think about it, things kind of point back to oil. So junk isn't much different. They're kind of proxies almost for one another. If I take a look at it, I always like to take a look and see, their dividends, and do we have beta on them? 0.42 here, and not available, right? One of the things, okay, and here's, I kind of watch this, okay, sometimes beta on these, on these more or higher risk bonds, right? The junk bonds, okay, the higher yield, okay, lower quality bonds, their beta tends to end up going up and being higher during bad markets. Because when they go to sell, when the markets go down, they go down pretty hard. Now, when the market goes up, like, it goes just straight up like a bat out of hell, their betas tend to be a little bit lower because, yes, they do go higher, but they don't run higher as quickly as the overall market. But yeah, great question on that.
See, Stewart said VIX should drop $1 by Wednesday, so he said VX19 combo price is about 1940, so they'll put by the call.
Now, here's an interesting thing about these. Was this Stewart who said that?
Yeah, David Stewart.
Okay. Dave, here's one of the things that's kind of interesting on this. I actually would prefer risk reversals. I know you like the 19, okay, but in some ways, okay, the implied volatility of these things at 150, I mean, it's just huge, okay? One of the things that I take a look at, now remember what we're doing here, okay? We are trading options on the VIX when you look at this. Would you ever trade the SPX and not care about what the VIX looks like? The answer is no. Everybody would look at the VIX if you're going to trade the SPX options. Well, you need to look at the VIX on the VIX, right? What's the volatility on the volatility index? And just so that you end up taking a look at that, and if people don't, if you're going to ever do something like that, and I'm sure that Dave does, but for the other people, this is the volatility. And let's go to just maybe let's do a weekly basis so you can end up seeing it a little bit better here. This is the volatility on the volatility. So for as long as VIX options on the data that they end up having, going back, and it actually does go back further, but the Thinkorswim just doesn't have it all. But take a look at what's been going on. Now remember, this is the VIX on the VIX, right? So this is the overall volatility. They use the same calculation and everything. This is where we had been trading, in the 60s, 70s, 80s, 90s. We'd get up to 100. Every time we got up to 100, okay, you could end up selling it. Look at what happened back in October. We got up to 142. Look at what happened here. This was a pretty quick round trip. This was a quicker run up. And, Dave, I also end up thinking it'll be a quicker run down. Now, I've been wrong. I've been dead wrong. So, it's, that and like $6 will get you a cup of coffee at Starbucks. Maybe a little bit less. After we get through the Fed meeting, now, if you remember, this is kind of like, deja vu all over again, to quote Yogi Berra. Last year, when I take a look at this jump in implied volatility, look at this. Does anybody remember last year, okay, this particular week, right where my cursor is? Why did volatility jump so high the second week in December? Okay. If you guys, I assume most of you guys have a life unlike me, but I remember what ended up happening. That's when Ben Bernanke was passing the reins to Janet Yellen, and we were fearful, will the quantitative easing stop? Okay, what's going to happen to the quantitative easing? Are they just going to pull the plug on it completely? And if you guys remember what happened during that meeting, Okay, they announced that they would go through a long tapering that the economy had them doing. They would do this over like a year period. Um, they weren't going to be buying back their stuff. They were just going to slow the rate at which they were doing their purchases, and the market loved it. You kind of knew. You kind of knew that Bernanke, okay, after doing all of this, wasn't going to end up saying, good luck, Janet. Let me know how it turns out. Okay, you knew that there was going to be a plan that they ended up having to work together, and that was the only fear in the market. So it was pretty comfortable. And Dave, I loved your trade in terms of like a risk reversal type of trade last year a lot more than this year. Because this year, yes, we have the Fed minutes or the Fed meeting coming out, and we're concerned, okay, is the language going to end up changing? Will that end up helping, sell off the market? But with the oil and the energy prices having so much of an impact right now, I would have thought that the budget. Now remember, when we ended up going back, remember how much, okay, the market ended up selling off, and the huge issues we had in early August of, 2010 we had the budget issue, right? And the fact that we ended up averting it, okay, it was also, do you guys also remember 2 years ago? If I end up showing you this, let me show you this. Where was it? Right here. Do you remember what this was? In 2012? It was the exact same issue, right? The budget, were we going to end up passing the budget or not? Were the Republicans going to end up shutting down the government? And they passed it, and look at what happened to volatility right afterwards. Got crushed. So I'm thinking, okay, we passed the budget yesterday, over the weekend. Okay, we're going to get volatility crushed again today. Absolutely crushed, just like it did last time. Nope, didn't happen. Didn't happen. Okay, if I show you this on a daily basis, I'm going to have to go to here, huh? Right here. Look at that. Look at that. Uh-oh, are they going to pass? Are they going to pass? They pass. Boom. Look where we open up. Okay, the next day. Right. So look at what happened this time.
Did he have any premonitions of what's going to happen after this Fed meeting, Jim?
The thing is that I don't. I don't. I think that okay, Yellen is extremely good. She's not going to end up doing anything that's going to throw the market into a panic. They're going to end up making sure that the language says that the Fed's there. You're going to have the, I don't know, I guess we originally started calling it the Greenspan put, then the Bernanke put. Haven't heard it called the Yellen put yet. But after this meeting, we very well might, because they might pass the put torch over to her. But again, we have this commodity issue, and it's not the pricing of the commodity itself that's causing all of the issues. It was, as I think it was Dave who ended up pointing out how, and I don't know how to take a look, by the way, of just energy trusts. I don't trade energy trusts, but boy, oh boy, you know what? I know what I'm doing tomorrow. I think that, at some point, if you guys don't own energy trusts, scaling in a little bit, every week, every day, over an extended period of time, several months, I think that you probably do well with that. Do we go lower before we go higher? The answer is probably. Okay, nobody can ever pick a bottom. You're not going to pick a bottom. So, just like what I end up doing to one of the institutions that I do a little bit of a consulting to, somebody owned, I felt so bad for this guy. He owned UVXY. Okay, he owns it. And what I suggested to him on this morning, right here, I said, you know, volatility's peaked up so high, I would end up starting to sell some calls on my UVXY, and that's the way I would get out of it if I owned it. And he called me up the next day, and basically he called me a jerk. See that? If I would have sold it, I would have lost money. I said, well, I wasn't suggesting that you sell all of them, but I would over the next, days or no more than a couple of weeks, I would be selling calls every day on my position. He never called me again after this day. I don't know why. Okay. Okay. So, boy, I got to tell you, with the market the way it is, I guess my best advice to folks is to just manage stuff with your size. Manage stuff with your size. You want to end up making a bet that vol's going to get crushed. Love the concept of putting something on, okay, like we talked about. The challenge you have is that everybody wants to put on that. So if I go back to, it was Dave. And if we take a look at this risk reversal, and then we're kind of running out of time, but, take a look at the 19. If you end up putting on the synthetic short, right, because that's what that would end up being. Oh, I'm sorry. I thought I changed that to VIX. I was like, that price doesn't look right. So you're going to spend $3.80 and only collect $2.45. Right? That's what you're going to end up taking a look at. The implied volatilities, okay, are actually higher on the puts. Now, don't forget, this is where the cash is. Where are the, I'm sorry, that was the 9 to 20. You said the 19. You're going to spend $3.07 and receive $2.70. That almost seems backwards, doesn't it? Usually people always want more money for the calls. So it's kind of like the market is betting, okay, with you, Dave, that they think that it's going to end up getting, collapse. So the implied volatility is kind of all, pushing you that it is going to end up coming down. Can you end up selling something over here? Yes. If I was going to end up putting on this trade, I'm not a big fan of being naked, okay? Because the problem is that if anything ends up happening and the VIX, goes up to 40 or whatever, you have to have your stop. If you're a good enough trader and you're a disciplined enough trader where you will end up honoring that stop or putting it in and you want to do it, okay. If you have the slightest premonition where I say, well, listen, I think I'm smart, okay, I think that the vols are going to come down, I'm not going to take it off, I'm going to let it sit. Or some people saying, well, you know what, if I like shorting it, okay, with the VIX at 19, I'm going to love shorting it when it's at 25. Don't do it. Don't do it. Please don't do it. You'll end up hurting yourself. And I have hurt myself in the past because I thought, well, it's got to come in. It does eventually, I think, but it doesn't have to in your time frame. It definitely doesn't have to end up, okay, doing it before your put expires or your futures contract expires or, all of the premium gets sucked out of whatever you were playing. So.
Oh, and Jim, David wanted me to tell you that he wasn't talking about a trade, just only pricing VIX at expiration this week.
Ah, okay, yes. Very, very, very true. David, great point, okay, and taking a look at, because it's the options on the VIX, okay, that really end up driving a lot of this stuff. But, one of the things that I took a look at, and I don't know if you ever look at something like this, but instead of pricing singles, sometimes I'll take a look at, well, what's a $4 spread looking like, a four-strike spread? Now, take a look. If I end up putting on the 1915, it's trading at $2.39 for a $4 wide spread. That tells me I'm not even getting paid 50-50 for it to end up closing below 15. That seems expensive. That seems very expensive.
Seems like the market's betting it's going to go down.
Right, because if you think about this, if well, I shouldn't say this about people, so I'll say it about myself. I can guarantee you, if I'm thinking that volatility is going to go down, okay, the quants, okay, at Goldman and other places thought about it last week. And they've already driven the volatility to a point where, whatever edge I thought I might have had is gone. So.
Well, a pretty full session here, Jim. I think we've hit an hour, so it's probably a good time to call it a day.
I think so. Guys, listen, thanks a lot for listening to my rant. Okay, I hope that you got something out of it, and I really, really look forward to this Thursday with Bill Visconto. I hope you join us.
Yep, sounds fun. All right,
thanks Tom.
everyone.
Good night.
And I'll see you in the trading groups on Wednesday and roundtable on Thursday.
Bye now.
Bye-bye.